Welcome to the Real Estate Investor Podcast. I'm your host, Gary Lipsky of Break of Day Capital. I talk to leading experts to discuss a wide range of subjects to educate investors on best-in-class practices to build legacy wealth and positively impact communities. Let's jump in. Hey everyone, welcome to another episode of the Real Estate Investor Podcast. I'm your host, Gary Lipsky. Today on the podcast, I have Andrew Westling returning. Andrew is Director of Capital Markets at Walker Dunlop, based here in Los Angeles. Andrew is responsible for new loan originations and closings for multifamily and commercial properties nationwide. Throughout his career, Andrew has underwritten and closed more than $1.5 billion in debt and equity financing for properties across the country, and I've worked with Andrew many, many times. Most investors rely on gut feelings, shiny brochures, or hype. And that's exactly how people miss red flags and lose money. At Break of Day Capital, we do things differently. We help investors make smarter decisions before the deal ever hits your inbox. From our educational webinars to our Invest Smart book to real tools like our portfolio tracker, we're here to give you the edge most investors don't even know they need. If you've been valuing our podcast and want to take the next step, subscribe to our newsletter. You'll get early access to webinars, new investor tools, and market insights sent straight to your inbox. Break of Day Capital, because smart investing starts before the deal. Financial advisor Bromley Palamountain of Northwestern Mutual empowers people to make their financial dreams a reality through purpose, clarity, and design. Be sure to check out his links in the show notes. Welcome to the show, Andrew. Can you start by telling the listeners a little bit about yourself and what you do?
Sure. Thanks, Gary. Always good to be on. Great to be back. Good to see you. So as you mentioned, Walker Dunlop, we are a national real estate investment sales and finance platform. My role is originating commercial mortgages and also some equity in multiple capacities across every asset class nationally. So our team, we do between $250 and $300 million annually in transaction volume, and looking forward to another strong year here in 2026.
Yeah, that is my hope as well. So let's jump in. Let's talk about the current lending environment, because it's, the rates are, the way I see it, and I'm not a lending expert, the rates seem pretty good, but there seems to be a lack of aggressiveness and lenders taking much longer than they should. Talk to me about it.
Yeah. I think there's two words that come to mind when I think about this market. One is selectivity, and another is normalization. And moving back towards a period of normalcy, right? I mean, I think back over the last, 7 years through, 2014 through 2021, where we had near zero interest rates and everything was kind of a race to the bottom on pricing because cap rates were so low, rents were just going up, and the economy was chugging along. It just, when everything shifted and the economy slowed down, we had a couple spikes through COVID of everything just shutting down, and then having rates increase so quickly. You just found that selectivity became the name of the game. There's still capital available, especially on the debt side and really on the equity side, because people have been on the sidelines now for, in some cases, a few years. But they're being far more selective on their markets that they're participating in, the asset quality, the leverage point, and also the sponsorships. And so, and I think about it too, because of where cap rates are today, and I think sort of this intrinsic valuation that a lot of owners of real estate have that isn't meeting that mark. Most of the transaction volume today is actually a wave of refinances coming off low rates into this new environment. And so it's driving more recapitalizations, and needing, I guess, more creative capital stacks to solve for the disconnect in valuations, NOIs today. And so it's really shifting from what was a cheap debt market, right, and a race to the bottom, now back to sort of normal, disciplined underwriting, and solving for that disconnect between.
Yeah, and solving is tough for operators that bought in 21, 22. Whether they do a capital call, they bring in some pref, Everyone has got to be creative with coming up with solutions. Um, you mentioned equity is out there. Is that more pref equity or common equity? What are you seeing?
Yeah, I think there was a huge rush and a pivot, even by a fair amount of senior bridge lenders to get into that space. And so I think there's been sort of a glut of capital racing into the preferred equity and mezzanine space. And so I think part of it is there is still common equity and JV equity out there. But I think a lot of it is put into either funds or started funds that are focused more on preferred equity and mezzanine because they saw the risk profile, they saw the return yield that you can achieve through it, and the risk profile maybe even being a little bit lower, right? You're protected a little bit more in the capital stack. And so I think, while it's still out there, again, I think about selectivity. There is common equity and JV equity, but they're really cherry picking assets and projects that they want to be in. And then they're looking for opportunities to place their own capital, which would have typically been JV or common equity, but now they're looking to place it as pref and mezz. So it's out there, but I think it's a smaller pool because so much of it is targeted and focused on placing it in another part of the capital stack today.
Yeah, I've seen so many people get in the pref equity space. I haven't found really much on the common equity side. And where I thought rates were like on the pref equity side, kind of coming down a little bit, maybe a year, 6 months ago, it's kind of gone, moved a little bit up again from my point of view. I don't know, are you seeing the same thing?
Yeah, I think it's opportunistic too, right? I
Yeah.
mean, whereas it's funny on the senior bridge loan market, it's become very competitive today and spreads have compressed because there's so much capital going into it. But leverage is still the leverage, right? I mean, you can only get so much up the stack in a senior loan. And so I think what you're finding is preferred equity and mezzanine check writers they're necessary now to make deals pencil and to make acquisitions go. And so they can almost write their own ticket, right? And say, you know what? No, actually, we're going to be at, I know we were at 13 last year, but we're at 16 this year. And if you can say no, but I know you're going to come back.
Nice. Yep, they got you.
Yeah.
So who are the most aggressive lenders right now?
I think it depends on how you define aggressive. I think it's bifurcated almost in a way. When I think about pricing, you have two buckets. For multifamily specifically, the agencies, Fannie Mae and Freddie Mac, are still just the low cost leaders in senior debt capital, right? They are aggressively priced. Their mandate is to finance affordable housing, and so you're rewarded for buying properties that have lower in-place rents compared to the AMI for the region. And so that is for multifamily specific. I mean, that for aggressive, that is pricing wise about as aggressive as you can get. For all other asset classes, life insurance companies and their spreads are very aggressive today. But of course, life insurance companies, they love lower leverage. They love higher quality assets and newer vintages, and they like larger markets. And even within asset classes, they like tend to migrate towards A and B type properties, even for industrial, multifamily, and grocery and drug anchored retail. So from a pricing perspective, I'd say those two are kind of the most aggressive. But when it comes to structure, which is almost more important sometimes,
Yeah.
especially for acquisitions and making them go in this kind of market, the debt fund and the private credit market has really become the go-to financier for assets, right? Because they can hit leverage, and they can offer typically more flexible structure and maintain non-recourse financing, which I know is so important to a lot of our borrowers. I would say 10 years ago, if you asked me that question, it would have been the commercial banks, right? Especially the regional banks. Maybe, selectively the big banks were playing in certain markets. But really through the pandemic, the pullback in bank lending was significant. And that really opened the floodgates for debt funds and private credit groups to come in and seize that market. You are seeing banks coming back in now slowly, some more than others. But I think debt funds and private credit, they're here to stay. What now that they have that foothold, and I don't see them receding anytime soon.
And do they typically do fixed rate or is it floating rate? And what's the range of rates that they're providing?
It's interesting because for a long time, for years, especially in sort of the early entrants in the game, it was all floating rate debt, specifically looking for value add transitional deals, the pricing was kind of dictated by how heavy the lift was, right? So if it was a light renovation, you could get really tight priced bridge debt, but if it was a really heavy renovation or a redevelopment or even an adaptive reuse, that's where the pricing would get wide. Now through the beauty of sort of financial engineering, a lot of these groups are offering some fixed rate alternatives, and that could be through a swap or some other hedge that they're using. But it's a really nice feature, and so you're no longer subject to just your traditional floating rate debt. Although I will say today those spreads have compressed, and it's a really attractive debt for the right deal, especially on the larger multifamily value add strategy plays.
Yeah, I think the whole swap piece is it. I don't fully understand. I've read a bunch, but if you can take advantage of it, it does offer some nice kind of manipulation, I guess, of your rate. If you want to talk about that a little bit.
Yeah, I mean, look, essentially what the banks are doing is they're synthetically fixing a rate by they'll issue the floating rate debt and then they'll synthetically fix it by hedging it, right? So at some point you have to unwind that hedge, and you can either come out ahead or come out behind. Now I'm a former banker. Now this is a past life going more than a decade ago, and we were writing swaps at the bank that I was working for, and part of the pitch was, theoretically, your swap could be in the money when you choose to unwind that hedge, and we would be paying you to be getting out of this. Typically, that meant you'd be coming out of a lower interest rate, fixed rate into a higher rate, and we'd be paying you to do that. So most people that were in the money weren't unwinding early. They were taking it all the way to maturity because there was no reason for them. The financial incentive wasn't enough for them to jump from that lower rate to a higher rate. I have heard I've heard anecdotally, I haven't seen it yet, some borrowers that are in the money today that theoretically could be paid as much as seven figures for unwinding their hedge. So, again, I don't know what that means for the specific loan, and if financially it makes sense to take on. I'm assuming that's a pretty low rate that's still fixed for a few more years, and you'd have to compare it to today's rates, see what the difference in interest is over the remaining duration, and see if you come out ahead. But that's the theory. Now, in practice, I've never seen it, but again, just having the peace of mind for a fixed rate execution, though, can mean a lot more to an operator, especially who's raising money from LPs. So I completely understand it may be taking that risk. And look, if you're in the money at the end of it, great. And if not, you at least maybe gave your investors a little bit more peace of mind throughout the hold period.
I've also heard about people talking more often lately of HUD and CMBS loans. I've had two bad experiences with HUD. I mean, it just happened to be me where we were just going backwards and wanting to put more money in and whatnot. And I know that they can be difficult, but if you get to the finish line, it could be very beneficial. But talk about the latest from those two lenders.
Sure. So we're the largest HUD lender in the country, Walker and Dunlop is. So we do a lot of that business. And they're very strict, right? As they should be. It's a government run operation where Fannie and Freddie are government sponsored entities, kind of quasi adjacent to the government. HUD, the Housing Urban Development, is a government operation. And so they have a lot of boxes to check. And that includes not just through the underwriting process, but also post closing. So their asset management is very strict. Their inspections are very strict, which is a good thing. Again, these are affordable housing communities almost exclusively that are being financed. And so, mandating upkeep and making sure that maintenance and safety issues are being addressed is extremely important. So I understand it, but you're right. It can be a labor of love for an operator, no doubt. CMBS has it has its place in commercial real estate financing. For those that don't know, CMBS stands for uh, commercial mortgage-backed securities. And what that means is a CMBS lender will originate a loan on a single property. It could be any asset class. The pros of a CMBS loan typically are non-recourse financing. They can typically achieve pretty high leverage, and they can offer interest only. So those three things are really good. On the backside, they're very inflexible. They have defeasance, which is a type of very inflexible prepayment penalty. And it's a securitized loan. So you're dealing with a servicer, not the lender at the end of the day, which can make requests or adjustments or anything, sort of, loan related maintenance very difficult or uh, to accomplish anything post closing. And so that one loan that they've just originated, they lump together with oftentimes hundreds of other CMBS loans. They package them up, they sell them off as bonds to end user investors. And so that's why once you're closed, you're now a bond. You're no longer a loan. So that's why really you can't make any changes post closing. So it's very, very inflexible. But for larger stabilized properties, it can be a really useful utensil for liquidity, right? Especially, it's sort of like the agencies for non-multifamily properties, right? The Fannie and Freddie can only finance multifamily, but CMBS, they can finance office buildings, retail, hotels, self-storage. And so you get a source of liquidity that can be lacking in the market, especially struggling asset classes. I mean, office loans are still getting done at the right leverage point, and one of the main originators of office loans today is CMBS. So it definitely has its place. But I always can caution, a balance sheet lender will give you more flexibility post closing theoretically than a CMBS lender ever could.
It's quite a puzzle when you're figuring out, putting the right debt on the property, your leverage, your rate, like what all these different things that you're, putting into the mix and figuring out what is best for you and how you're going to complete your cap stack. Um, it's quite it can be quite stressful for someone trying to figure it out.
Yeah, and it's really, it's almost from a capital markets perspective where I sit, doing loans every day, the market's almost bifurcated, right? I mean, there are balance sheet lenders, right? Like life insurance companies and some regional banks. They're just conservative by nature, right? And they're looking for core deals, low leverage. They love fresh equity coming in or low leverage refinances. And that's their bread and butter. And that's what you're going to get from that pool of lenders, right? But on the other side, you have the private credit and the debt funds and CMBS, and I'll even put the agencies in there as well because they can when the sponsor needs more leverage or perhaps a different structure or creativity. That's where they can get it. It's really hard to find someone that's doing both or one lender that's going to give you both.
Yeah. Speaking of creativity, what are you seeing or, when you're looking at maybe refinancing a deal that has lost 30% value or even trying to put together a capital stack these days where raising capital is a struggle. And so you either have to do really small deals or get creative. So what are some of the things that you've seen or have been doing?
Yeah. I mean, the biggest one that we touched on again is preferred equity and mezzanine debt, right? To bridge that gap. And for those that don't know, so preferred equity is a tranche of the capital stack that sits behind the senior debt but ahead of the common equity. And mezzanine debt is essentially the same but structured actually as subordinate debt. And it's secured by equity interests in the ownership entity that owns the property. Both command similar returns to the ultimate investor or lender that's making that check, which is typically call it mid-teens, right? So it's not unheard of to see 13, 14, 15, 16, 17% for taking this position in the capital stack. But again, oftentimes it's necessary. If you bought a deal in 2021 that had 3.5% debt on it, and you're refinancing today at 6.5%, that new loan, there's no way you're going to take out the existing loan. So you're either cutting a check with common equity, right? with your own money or doing a capital call to your investors, or you need another way to bridge that gap. So pref and mezz have been by far the biggest piece to that puzzle. The other way is maybe bringing in a JV partner to recapitalize. So we've seen that a fair amount. That's not a rescue situation typically, right? That's more of a either what we call like a well operating property that has capital markets distress, or it's a property that's just sort of chugging along and is neither distressed nor does it have anything, but you need someone to come in and put fresh capital into it. On the other side, there is rescue capital out there. And again, that is probably more expensive than pref and mezz today, right? And there's not a lot of it. And I would be wary of taking on those types. But I guess in some cases, some folks they'll need that as a piece. So that's out there. We've seen others just to get sort of again sort of nuanced but creative. We see some lenders splitting A and B notes, right? So they'll issue one loan to the borrower, and then behind the scenes, they'll split it into an A note, which is lower leverage, and a B note, which kind of acts like pref or mezz. And they'll either retain the A and sell the B, or sell the A and retain the B. So they're really de-risking their own position because they're not, by laying off one piece, the A or the B, they're either feeling really comfortable in their senior that they're holding on to, or they're feeling really comfortable in their basically pref or mezz that they're holding on to, but they've been reimbursed for that A note so they can go and make new loans. So that's one way that I think lenders have gotten creative. The other thing that I'm hearing, I don't see it very often, but seller financing has made sort of a quiet comeback, right? And now it's difficult because a lot of lenders will not allow for seller financing to be subordinated behind, say, a first trust deed. But I've heard that some deals have gotten done without a traditional third party conventional lender and instead have just gone seller financing over the last few years because that was the only way to make it go. And then the last one is probably a little more nuanced, but it's on the cap stack side is structuring preferred LP structures, right? So when you're bringing in your investors and they're limited partners and they're writing checks to you as the equity, you can tier those classes, right? A, B, and C, 1, 2, and 3, whatever it is, and you can actually give folks preferred structure similar to a preferred equity position, but it sits in the LP. And so that's really interesting too, because then if you're able to structure it correctly, you could theoretically put a senior note, a preferred equity piece, and this preferred LP structure as part of your cap stack to reduce the common equity need on an acquisition. So again, a lot of different ways to do it. Not every creativity or creative structure will work for every transaction, but I think it's worth exploring a lot of them in a lot of ways because, again, to make deals go today, to make them pencil, you probably need at least one of those. It's hard to make it just the playbook that was from 7 years ago with one senior loan and equity. It's hard to find it. You don't really see it today.
Yeah. Particularly, yeah, a lot less leverage and a lot less investors because they haven't had liquidity events there or a capital call, or they're a little bit wary, or they've done well with Bitcoin or the stock market and gold. And obviously there's been some pullback, but there are other investments that have done well. And so the desire to put money into multifamily or other real estate asset classes has been less desirable.
Mm. I just heard it anecdotally. We do source equity. It's mostly at the institutional level, which has been fairly consistent. I mean, there are groups, again, selectivity comes to mind, but there are folks and institutions still writing checks, especially for joint venture equity and even LP equity on a programmatic basis. But I have heard, from clients and from and friends that raising limited partner equity has been tighter over the last really 2 years, that far tighter than it was than maybe the 5 years leading up, but there was almost a freeze on it for a while in about 2023. And then slowly in 2024 and 2025, you've seen that market come back, but not as robust.
Yeah. Yeah. Definitely a struggle, and people, that I talk to, everyone is struggling to put that cap stack together. So
And look,
having
at the end of the day, the senior loan it's not doing as much work today as it was 5, 7 years ago, right? And so what that used to be the workhorse in all of these deals. And when that's no longer pulling its weight, you need to find another way to get it done.
yeah, yeah. And that's not such a bad thing, that not have as much leverage, but putting all the pieces together, yeah, it takes a lot of hard work, a lot of creativity, and a really good
Mm.
loan officer broker to work with, to kind of guide you through and put all the pieces together, like you.
Mhm. I appreciate that.
Well, Andrew, thanks so much for coming on the show and educating our listeners. Please tell the listeners where they can find out more about you and what where to reach you. So.
No problem. So Walker and Dunlop, we're a national platform. I'm based in Los Angeles. You can find me on LinkedIn, Andrew Westling. My phone number is 310-979-5756. Feel free to call with questions. We're always available to be a resource. We have tons of data, and we love hearing from our clients, sponsors, and friends.
We'll put that in the show notes. And like I said, I definitely recommend Andrew. This is Gary Lipsky signing off. Thanks for joining us. We'll see you next week on another informative episode on the Real Estate Investor Podcast. To all of our listeners, thanks for joining us. And if you like this episode, please head over to iTunes or Stitcher and subscribe, and leave a review, as it will help us reach more people. And if you'd like to learn more about what we do at Break of Day Capital, head over to our website at breakofdaycapital.com and sign up for our newsletter and fill out our investor application. We'll talk to you next week.